The AI stock boom is everywhere. Every headline screams the same thing. Artificial intelligence is the future. AI will replace jobs. AI will make investors rich. AI stocks are unstoppable. But here's the real question no one wants to ask. Is this an AI revolution? Or are we watching the next massive stock market bubble forming right in front of our eyes? Today, we're breaking down the reality versus the hype behind the AI stock boom, using history, numbers, and cold logic. Let's start with why AI stocks exploded in the first place. Artificial intelligence is not a new idea, but what changed recently is scale. AI suddenly became powerful, commercial, and profitable, at least on paper. Companies started integrating AI into everything: search engines, advertising, customer service, medical research, finance, even military systems. Investors saw one thing clearly: growth potential. And Wall Street loves growth more than anything else. That's when AI stocks began to rise fast. Some companies doubled, some tripled. Some added hundreds of billions of dollars in market value in just months. But rapid growth always creates one dangerous emotion: FOMO, fear of missing out. Retail investors jumped in, institutions followed. Media fueled the fire. Suddenly, every company mentioning AI in earnings calls saw its stock jump. Now here's where the hype begins. Many AI companies today are priced not on current profits, but on future promises. They're valued based on what they might earn 5 or 10 years from now. This is where history becomes a crucial guide. We've seen this pattern play out time and again. Case study 1, the dot-com bubble. In the late 1990s, any company with .com in its name saw its stock price skyrocket. Investors poured billions into businesses with no profits. The promise of a new internet-driven world was real, but the valuations were fantasy. When the bubble burst, companies like Pets.com and Webvan vanished, and the Nasdaq lost nearly 80% of its value. Case study 2, Tulip Mania. In the 1630s, speculation in Holland drove the price of a single tulip bulb to more than the cost of a house. It was a market driven by pure emotion. The crash was swift and devastating. In both cases, a revolutionary new thing was real, but the price people paid became disconnected from its actual value. That doesn't mean AI is fake. It means pricing matters. Here's the uncomfortable truth. AI will absolutely change industries. AI will create trillion-dollar businesses. But not every AI stock will survive. Right now, many companies are burning cash. Some have weak business models. Some are simply riding the AI buzzword without real competitive advantage. Investors aren't asking the right questions. They should be asking, does this company have real revenue from AI? Does it have pricing power? Does it solve a real problem or just sound futuristic? When markets stop asking these questions, bubbles start forming. Another major risk is concentration. A small number of AI giants are driving most of the gains in the stock market. When too much money flows into too few stocks, the system becomes fragile. If growth slows, if earnings disappoint, or if regulation tightens, the correction can be fast and brutal. But does that mean a crash is guaranteed? Not necessarily. This isn't pure speculation like past bubbles. AI is already being used at scale. Companies are generating real productivity gains. The difference between a crash and a correction depends on expectations. If investors expect perfection, markets punish mistakes. If expectations reset, markets stabilize. So what's the smart move for investors right now? First, separate AI as a technology from AI as an investment. They are not the same thing. Second, avoid chasing hype at all-time highs without understanding valuations. Third, focus on companies with strong balance sheets, real customers, and long-term moats. And finally, remember this: every major technological revolution creates both massive winners and painful losers. The people who win aren't the ones who panic or blindly chase trends. They're the ones who understand risk, timing, and discipline. AI is not going away, but blind optimism always does. So the real question isn't, will AI change the future? It already is. The real question is, are investors paying a fair price or an emotional one? And that answer will decide who makes money and who gets wiped out.